I think the biggest mistake I see investors make is hiding information from their broker.
Can somebody, in your opinion, go from owning zero property to having a portfolio in 2 to 3 years, realistically speaking?
Yeah, big time. Yeah, I've helped multiple clients do that.
And what's the biggest lie people have told you about real estate investing in Toronto?
I think the biggest lie in today's world about real estate is that.
Welcome to MLB Renovations TV. Today's episode is very, very special if you're an investor in the multifamily space in the GTA or the Golden Horseshoe area. Today, I'm going to interview Ribhu Rampersad, who's a mortgage broker who specializes in multifamily commercial financing, especially CMHC, and is very knowledgeable. So let's go talk to Ribhu. Hey Ribhu, how are you?
Good, man. How's it going with you?
Good, good. How's life?
Been busy, man. Busy.
Yeah?
But all good things.
Okay.
Hit Trinidad a few weeks ago.
That's good.
Got away from the winter for a bit, and now we're back in the cold.
Is it really cold over here right now?
For me, I'm Caribbean boy, so yes, I'm freezing.
How's the market? How's business?
Business has been busy, man. It's been interesting to see how people have been moving capital, especially with a lot of people who've been sitting on cash the last few years. It's interesting to see them make moves in the market right now.
Okay.
There seems to be a lot of opportunities out there, especially with CMHC financing.
Okay.
And I think big money are making big moves right now.
Big money's making big moves.
Yes.
Okay, and you're the big money guy.
I try to be.
Okay. So, question, what's the biggest difference between a single family home and a multifamily home? Walk me through that.
Yeah, it's definitely something I wish I knew when I started off. So, residential financing and commercial financing are very different processes.
Okay.
The biggest difference is residential single-family home financing is highly reliant on your personal income.
Okay.
Whereas multifamily financing for units, at least 5 units and above, relies heavily on the net income of the building itself.
Mm-hmm.
It's really important to understand this because that's really how investors are able to scale. Because at a certain point, as a lot of investors probably know, you hit that roadblock of the bank saying you no longer qualify. So at that point, it's either do I continue to scale using expensive private financing or shift into multifamily real estate where now the building financials really matter in the qualification.
Okay.
Yeah.
And so let's say if I'm buying my first multifamily deal, what will a lender look at?
Yeah, so two key things. So one, they'll look at your personal profile, but not in the way a residential lender would. They'll look at your net worth, and they'll look to make sure the story makes sense. So they may not necessarily look at your personal income, but they want to understand what you do for a living, that sort of thing. So borrower profile would be number one.
Okay.
And two, the property profile itself. So what is the net operating income of that building? So all the rent minus all of the expenses. And just, general condition of the building. If both of those check out, you usually get a loan. It's interesting because sometimes I feel getting these commercial mortgages are easier to get than residential once you have the cash.
Okay. So, and what do you think, how are the rates looking in 2026? Are they going up? Are they going down? What's the landscape?
Yeah, so my answer will be very different before and after March 1st, 2026. Since the war broke out in the Middle East, we've seen a huge reversal in where rates were going. Prior to this, rates were actually on its way down. People were getting very optimistic about the market. But since that has happened, we've seen a complete reversal. A lot of commercial mortgages and fixed rate mortgages in the residential space actually are really priced based off the Canada Mortgage Bond or related in some way. We've seen up to 50 basis point increases depending on the day on the Canada Mortgage Bond yields. This is, wrecking the market right now, especially fixed rates and any commercial financing. So while prime stays steady for now, the mortgage bond and the fixed rates and the CMHC rates and the commercial rates have completely reversed course.
So what are the common mistakes you see investors doing when they secure multifamily financing?
I think the biggest mistake I see investors make when trying to secure multifamily financing is hiding information from their broker.
Okay. That's interesting.
Yeah, I think people forget to realize that your mortgage broker is on your team.
Okay.
And the more information he has to work with, the better he can position the file and ensure there's no last minute surprises.
Okay.
That second mortgage you don't want to tell us about, that, extra property you don't want to tell us about. Those things actually help to know when it comes to multifamily.
Okay.
For example, that extra property you're trying to hide,
Okay.
that'll help your net worth profile.
So why
as an
would people
example.
hide these things from a mortgage broker?
I found that a lot of people like to keep their cards close to their chest. I couldn't give a good reason why, but people just like to share the minimums.
Okay.
And it's interesting because, for not everybody there, but there's some people who would say, okay, what's the minimum requirement for CMHC? It's 25% net worth of the requested loan amount. So on their net worth statement, it would magically be exactly 25%.
Okay.
But what they fail to realize is that, the more you share, I can position it in the best way. And, commercial files are priced based on risk.
Okay.
So the more I can share with the lender, the better your pricing is going to be, the better your term is going to be. As well as I can spot any red flags early on in the process and flag this to the lender up front. A lot of time, especially in the commercial world, the perceived red flags aren't actually red flags.
Okay.
And being transparent from the start ensures no last minute surprises. And, you don't want a lender pulling out a deal when you're a week from closing. Yeah.
Okay. So walk me through what is CMHC and how does the loan work
Sure.
for multifamily units?
Yes, for multifamily. So CMHC is a mortgage insurer.
Okay.
They insure mortgages, both residential and commercial.
Okay.
But specifically in the commercial context for multifamily, properties 5 units and above,
Okay.
they help facilitate really attractive loan terms.
Okay.
So something important to understand for commercial financing is the concept of a debt coverage ratio,
Okay.
which is your net income divided by your mortgage payment. So generally speaking, for commercial financing, and each lender is a bit different, that ratio is typically between 1.2 to 1.25 for most financing applications.
Okay.
So what that means is you need to make between 1.2 to 1.25 times net operating income than your mortgage payment. So
Okay.
if your mortgage payment's $1,000, you need to be making $1,200 to $1,250 a month in net income.
Okay. That's a summary.
That's a summary. Now, why that's important is CMHC insured financing enables a few things. 1, better interest rate. 2, longer amortization. And a lower DCR requirement. So as you could imagine, if you have a longer amortization and a lower interest rate, your mortgage payment is going to be smaller, which now, and now with a lower DCR requirement, simply put, on the same asset, you could get a much larger loan than conventional financing.
Okay.
The other attractive thing is a typical commercial deal, and there's exceptions, but the typical commercial deal will require minimum 25% down, whereas CMHC insured loans can go as little as 5% down.
Okay. What do you mean by 5% down? There's a specific product with CMHC, MLI Select. I think
Yes.
that's called MLI Select, right?
Yes.
So can you explain that?
Yeah, so CMHC, even prior to MLI Select, offered insured multifamily mortgages.
Okay.
CMHC standard.
Okay.
It was, a function of do you debt service,
Okay.
and you'd probably get the loan, right? Maximum 85% loan to value. So they would fund up to 85% of the value of the building.
Okay.
Now, MLI Select came along, which, I've heard people call it the Lamborghini of mortgage financing.
Interesting term.
Yeah. I didn't come up with it. I've heard it from others. But what it introduced was a point system.
Okay.
Where you score points in 3 buckets.
Okay.
Affordability, energy efficiency, and accessibility.
Okay.
Now, you don't need to score points in each bucket.
Okay.
Each bucket, the points allocation is different.
Okay.
Now, what that enables is different terms. So, for example, on a CMHC standard, on an existing building, the maximum amortization you could get on a loan is 40 years.
Okay.
MLI Select, you can get up to 50 years depending on the number of points that you get. As well as, CMHC standard, you would get max 85% loan to value on your loan. MLI Select, you can get up to, based on the number of points, 95% loan to value. Now, there's other perks, insurance premium savings, and all of this fun stuff. But that was the biggest difference when MLI Select came along, is you had an option now to get cheaper insurance premiums, lower DCR requirements, more aggressive loan to value approvals, if you met certain criteria. Now, over time, those criteria have gotten stricter and stricter. So, for example, a year, 2 years ago, I lose track of the dates now, you could have probably gotten 100 points, so full benefits with just energy efficiency points.
Okay.
They've scaled that back now where you can only get 50 points with energy efficiency. As recently as a couple months ago, they've actually made energy efficiency on new construction even harder to get.
Okay.
And really driving the developer or investor to have to commit to affordability.
Okay.
Indirectly, like they're not saying you have to, but the
Okay.
way they're shuffling the points,
Okay.
they're shifting that consumer behavior quite a bit.
So is it discouraging investors?
I'd say it has discouraged a big pool of investors for sure. So one of the recent changes is the energy requirements. So now the percent that you need to be above building code has increased drastically depending on what you're building, which now obviously has a bottom line impact to your cost, right? So that's turned off a lot of investors, especially investors who had development projects in their pipeline. Now, in a 4+1 6-plex type project, while its cost impact, it may not be huge, but you could imagine if now the percent, above building code increases by 30% now across 183 unit development, you can imagine what the cost impact is going to be.
Yeah.
And then it's really shifted people to have to do affordability. If they want to get 95% loan to value, if they want to get 50-year amortization. So it definitely turns some people off. Now, on the flip side, there's a lot of people who've learned how to navigate the system. They understand the game. They understand that it's still better financing than anything else on the market.
Okay.
So, if you have the capital to play the game, it's still the most attractive financing tool out there, in my opinion.
Okay. And what do you think are the hottest market for these multifamily developments in Canada?
Yeah, so that's hard to answer directly because I think it depends on what you're looking for.
Okay.
So, for example, if you're looking for maximum leverage, solid cash flow, minimum down, easy to get points, the Alberta market has actually been really hot.
Alberta. Okay.
Yeah, there's a lot of
Calgary?
investors. Calgary, Edmonton, there's been a lot of investors flocking to those markets because, and a big reason why is the affordability metrics.
And we're talking about 5 units and plus, right?
Correct. Yeah.
Okay.
And that affordability metric is an important factor in why people are going to Calgary and Edmonton. So affordable rent is defined as 30% of median renter income for that area. So I'm going to use round numbers.
Yeah.
Roughly speaking, it's about $1,370 a month in Toronto, which is the affordable rent definition.
For a 1-bedroom?
They don't specify.
Okay.
Which is interesting. They don't specify yet, I should say. Take advantage while you can.
Yeah.
And in Edmonton, Calgary, and again, I'm using round numbers, it's about $1,650 a month for affordable. Yeah. The interesting thing is the market rent, let's say for a 2-bedroom in the GTA is $1,800.
Yeah.
And the market rent in let's say Calgary, Edmonton is between $1,600 to $1,700. So
not a huge difference.
no, so you're not really sacrificing.
Yeah.
In some markets in Alberta, your market rent's actually lower than the affordable rent definition.
Okay.
So people are able to get 100 points just by committing to affordability.
Okay.
And very easily versus Toronto where you're sacrificing 1, cash flow, but 2, the actual valuation of your building.
Okay. And I believe the entry point is much cheaper over there in Alberta?
It can be.
Okay.
So it depends on what you're buying. So a lot of investors are flocking to new construction developments in Alberta.
Okay.
Those tend to be higher price per door. Business case to be made is brand new construction, carry on warranty, etc. But there's also options in the Alberta market where you can buy existing stock for very, very cheap.
Okay.
Some investors also like that because there's no rent control. It's a lot more landlord friendly. So there's pros and cons for the Alberta market. So
and what would you do? Like, would you buy new construction if you go into multifamily, or you would buy existing buildings, 5+ units, and then convert them, or just buy them right away and if they're rent ready?
Yeah, I think it goes back to your own risk profile as well. So there's some investors who want to buy brand new.
Okay. Why is that?
They maintenance. They don't want to deal with maintenance.
But it's a higher price point. Oh.
It is a higher price point. I think their logic, is more around, you can get high leverage.
Okay.
Minimum down. Alberta also doesn't have land transfer tax.
Okay.
So like on a $2.5 million building, you're putting $125,000 plus closing costs into the deal.
Okay.
And you're probably making, decent cash flow. Others are saying, hey, I can buy
You are making decent cash flow, you're saying. Positive cash flow?
positive cash flow. I mean, so by nature of that
Yeah.
DCR calculation, you have to be positive cash flow.
Okay.
So on commercial financing, you have to be positive cash flow, or they'll reduce your loan until
Okay.
you meet that DCR requirement.
Okay.
So yeah, you have to be, or you get a smaller loan.
Okay. And then you put more money down
Yeah.
until you positive cash flow.
Essentially, yeah, you need to
Yes.
meet that DCR requirement.
So you think Alberta market is better than a Toronto market?
I wouldn't say better. So that's where I think it depends on what you're looking for. So,
Okay.
you're looking for turnkey, get in the market, maximum leverage, that type of thing. That's, it's good to go. Ontario market becomes a lot more challenging because of obviously the landlord tenant board here.
Okay.
I know that's what turns a lot of people off. That being said, I would argue fundamentally, if you're buying in good areas in Toronto, Hamilton, like anywhere in the GTA, really, if you're buying in good areas, good units, there is a business case to support that long-term equity growth.
Okay.
All right, where you may not be getting 5% down, you might be putting 15% down. But the dollar impact of every dollar in rent that you increase,
Okay.
goes a lot further in terms of valuation.
Okay.
So a commercial property is valuated based on something called a cap rate.
Yes.
All right. So in markets like Toronto, you're seeing between a 4.5 to 5 cap.
Okay. Which is good or bad?
I mean, from a cash flow standpoint, it means you're going to have less cash flow. From a valuation standpoint, it means every dollar you increase, your valuation goes that much further.
Okay.
So it really, I think ultimately to answer your question, like in one sentence, it depends on what your goal is with your investment.
Okay.
If you're looking for cash flow heavy plays, like proper, you're probably looking in either tertiary markets in Ontario
Okay.
or markets like Alberta. If you're looking for more predictable equity growth, Toronto is probably a good bet.
Okay.
Now, I've heard people who love and hate Toronto. They love Toronto because they believe in the long-term fundamentals of the city and they like where it's going, on a macro level. And then they hate Toronto because of the cost is so high versus the rent you're going to get.
Okay.
So I think it just, really matters on what you're looking for. The other factor to consider is, do you want to manage properties at a distance? I have seen investors in all markets, in all asset classes make money. So it really boils down to how much cash you have to work with and what your goals are.
So let's say if an investor lives in Toronto or the GTA and he sees this podcast and he says, oh, I'm going to go and invest in Alberta.
Yeah.
Is it feasible, like long distance management?
I think it's feasible.
Do you have any clients who are doing this right now?
I have lots of clients who are doing
and
it.
are succeeding?
Yeah, I have lots of clients who are doing it and succeeding.
Okay.
I think, but I think what I'm about to say is independent of Alberta or Ontario.
Okay.
It's doing really, really good due diligence on the team that's going to represent you, specifically your property manager.
Okay.
Because your property manager is going to make or break the deal. Because they're the ones doing due diligence on the tenants. They're the ones maintaining the property on an ongoing basis.
Okay.
So yeah, I think it's definitely doable. But you need to have a rockstar property manager on your team.
Okay.
Yeah.
Fair enough. And what do you think is the trend right now in Toronto with all the zoning changes? Are people doing 6+1, 5+1? What are they doing?
Yeah, so yeah, definitely seen a big uptick in this sort of mid-market development. For the most part, we've seen a lot of 4+1s being built. With the zoning changes, we're now starting to see that shift into 5+1s or 6plexes, as is, sixplex by default.
What do you call a sixplex? How do you define a sixplex?
So six.
Like you buy a single family home?
Yeah, so a lot of these projects, they're tearing down and then building ground up.
Okay. So like basement, main floor, second floor,
Yeah.
third floor?
Yes, third floor in some
And
cases.
then fourth floor also?
A lot of times, most people are doing the laneway suite or the garden suite in the back
Okay.
to hit the extra unit.
Okay. So basement, and I've seen some properties where they have two basements.
Yes.
So 1 unit, 2 unit, 3 unit, 4
Yeah.
unit, 5 unit, and the 6 unit in
Correct.
the main bay.
Yeah.
So that's how you do 5+1, 6 units, right?
Yeah, exactly.
Have you seen any 7 units?
7 units, not really. So
Okay.
I think what's happened is so sixplex by default, right?
Okay.
Until recently, that wasn't the case. And then once you started to get above 6 units, you started to have to pay development charges.
Okay.
So anecdotally, I've seen a lot of investors who weren't doing the 4+1s. If they wanted to do bigger, they jumped straight to 10.
Okay.
Because 10 is like, and I'm not a zoning expert, so don't quote me on this, but I believe 10 is, you don't need site plan approval.
Yeah.
So I think a lot of people, when they started to go through zoning changes and DCs and all of these things, they're like, well, let me just go straight to 10. That's a max I can do without needing SPA.
But that's like new construction.
Yeah, these are all new construction.
Yeah.
So there's a lot of pros to doing new construction versus retrofitting an existing home.
Okay.
A big one is the HST rebate.
Yes.
Because you get HST rebated on brand new construction, which is huge, right?
Which is about 13%?
Yeah, 13%. So on a $2 million project, you're getting $260,000 back you won't get on a retrofit.
Okay. Plus low maintenance costs and all that stuff.
Low maintenance, as well as CMHC's terms on new construction is very different to what would be versus existing.
Okay.
Yeah, because now it's defined as an existing building rather than a new construction.
Okay.
So now your your point system, there's two separate sets.
So they will reward new construction in the point system.
Correct.
Okay.
They are rewarding it. Yeah.
Okay. So you get HST rebate, you get better financing.
Yeah.
And you get better maintenance, like low maintenance.
Yeah.
So there are benefits of doing new construction on an existing lot.
100%.
Okay.
And I'd say even the construction financing options are a lot more attractive too. Like lenders have a lot more appetite for brand new construction because it's clean slate, right?
Yes.
It's clean slate. Toronto, you typically have a good builder like yourself on board.
Yeah.
It's like, it's very cookie cutter in that regard versus a retrofit. Like
retrofit is complicated.
Quirks, every property is a little different.
Yeah.
You don't know what you're going to find. So yeah, a lot of new construction.
And what are the timelines you're thinking or you're looking at? Like, walk me through the process. Like, let's say if I'm an investor and I buy a property in Toronto and Hamilton, anywhere, and I'm thinking of tearing it down and putting, let's say, a 10-plex.
Sure.
So how much money do I need?
Yeah.
Number one, down payment.
Yeah.
And then when do I come to you and how will the financing work? Walk me through the money timeline.
Sure. So I will say if you're doing ground up construction, it like you need cash.
Okay. How much cash do I need?
Yeah. So we're going to walk through it.
Yeah.
So obviously value add is going to take a lot less cash.
Mm-hmm.
But let's
first thing is we need money for the down payment, right?
Correct. So let's say we were buying land in Toronto.
Yes.
Most people, they would put some sort of conventional loan on that property.
Yeah.
20 to 25% down on acquisition.
So let's say the buying price is about $1 million.
Yeah, so
that's the average.
200 to 250 plus closing costs. Keep in mind, land transfer tax in Toronto is double.
Yes. Okay.
Right. So you're probably 350 to 400 all in.
Hard cash.
Yeah.
Day one.
Day one. You own the land in Toronto.
Okay.
Yeah, so that's rough math. So usually people put some sort of conventional debt on it while they work on permits, soft costs, all that stuff.
Yeah.
Right? Because once the demo, we usually replace with construction financing at that point. Now, the caveat, CMHC provides construction financing.
Yeah.
Okay. The caveat being, you also need a lender to approve the construction financing.
Mm-hmm.
On the commercial side, not a lot of lenders have appetite for smaller construction loans.
Okay.
So generally speaking, getting sub $3 million construction loans is very, very tough to get. So most people tend to use some sort of conventional construction financing and then go to CMHC for the takeout.
Okay.
So conventional construction financing can either be some sort of private capital firm.
Okay.
So these are private but institutional guys. So it's not like, hard money. It's like...
They're not loan sharks.
They're not loan sharks. They, especially if you're in GTA proper, you have a lot of firms who specialize in this sort of space with attractive terms.
Okay.
Or you can get credit union construction financing.
Okay. So I'm at 350. I own the land.
Yes.
Now I get my permits, hire my architect.
Yeah.
All that's soft cost. Let's say I'm $50,000.
Yes. You're in. Yeah. So 400 grand in.
400 in.
Yeah.
Now where do I go?
Yeah.
I go to these private guys because I'm not going to the CMHC.
Yeah.
I go to these private guys and they will lend me the money, or should I? Will I need more money?
Yeah. So you would need some more money. So what typically, and again, you could get more aggressive, less aggressive, but on average, a lot of lenders will lend 75% of the cost of the project.
Okay.
Okay, so they'll add up, your hard cost, soft cost, land cost,
Yeah.
and then they'll say we'll fund up to 75% of that,
So I need money till the foundation and all that stuff.
roughly speaking. So
Okay.
what they'll look at, so let's use the example of like a private capital firm. They'll look to see that you have 25% project equity before they start advancing new funds.
Okay.
So let's say it's a $2 million project. They would want to see at least the 500K. And again, using round numbers.
Yeah.
They'd want to see at least 500K of project equity.
Okay.
Right. So, that includes your down payment and stuff. Not all lenders will fund soft costs. Some do, some don't. But roughly speaking, you need 25%.
So you need to have a $500,000 hard cash if you want to embark on a new construction project, which is worth like two.
So minimum, because there's a couple other things. So there's what you need to meet the minimum requirement, and then what I would recommend. Because there's a couple factors that people need to consider.
Okay.
One is HST. So while you're getting the HST rebated, you need to pay it up front.
Yes.
So from a cash flow timing standpoint, you need to be able to pay that.
Yeah.
You got to pay trades, you need to buy materials
Yes.
until you get the rebate.
Yes.
Second thing is a construction lien holdback. So especially in Ontario, there's something called a construction lien holdback.
Yeah.
Where in every construction draw, they're going to hold 10% of that draw in a trust account until substantial completion of the project.
Yeah.
So while you're going to get that money in that moment in time, if you get a 200K draw, they're going to hold back 20 grand.
Yeah.
You still got to pay that 20 grand to people.
So round about 700K
I'd say
is a comfortable number.
I'd say 800
800. Okay.
because liquidity, you got to pay deposits, all that stuff.
So you need 800K cash to do a $2.5 million project.
On the average side, yes.
Okay.
Yes. Sometimes, there's some lenders or credit unions, you need a little bit more cash, but their terms are a lot better in terms of interest rates. Then there's some like private guys who, you may need less money, but the rates are going to be more expensive.
So let's say you spend 800K over a period of 2 years.
Yes.
It takes you 2 years to,
Yeah.
find tenants,
Sure.
get tenants in,
Yeah.
build the project.
Yeah.
Then you go to the CMHC. And then how long will that process take to refi that out?
Sure. So
Get your 800K back.
yeah.
Get to that 5% thing.
Yeah. So the CMHC process, the wait time changes a lot by the year. By the time of the year, sorry. I'll be careful what I say, but they are a government organization, and it goes based on vacation time, anecdotally. I don't have data to support this. I can just tell you based on my experience.
Yeah.
Summer vacation, the wait times are a lot longer.
Okay.
Currently, as of today is what, April 6th?
Okay.
The wait time is not very long right now at CMHC, 2 to 3 weeks.
Okay.
So from a timeline process, it's about, assuming we have full package, appraisal, net worth statements, everything, it's about 3 to 4 weeks on the lender front because we need to get a lender to sign off. And then probably another 3 to 4 weeks on the CMHC front. And then the lawyers need to do their thing. So in total, probably between 3 to 4 months before you have cash in hand. Which is not too much more than another commercial process, still longer because you have the extra CMHC step. There was a moment in time where, you were looking at months before you heard back from CMHC. That's not necessarily the case as of today.
And why is that?
They're
more aggressive or what?
That's a great question. I don't have a specific answer whether they hired more people or what, but recently the times have been good. Now, where we see big backlogs happen is every time there's a rule change. So, for example, the energy efficiency change that I mentioned earlier, that takes effect at the end of September this year. So they've already announced the rules, but they're accepting applications with the old energy efficiency requirements until the end of September this year.
Okay.
I would imagine anybody who submits, there's going to be a huge inflow of applications in that last week of September, which would mean October, November, you're probably going to see a backlog.
Okay.
So it really changes, I think, based on, how rule change timing, seasonal timing.
Okay.
Yeah.
And what do you think is a better market to invest or do multifamily, Toronto or Hamilton?
Again, I think it depends on your goal. So I think Hamilton is going to be a lot more cash flow heavy, just by the nature of being a secondary market.
Okay.
Typically...
Lenders are not really confident about Hamilton?
No, I would say lenders are confident about Hamilton. And I'd say, you'd probably get more cash flow because your dollar per unit versus Toronto tends to be lower.
Okay.
So I'd say a lot of the really good deals that I'm seeing in Ontario are in like the Hamilton, Brantford markets. That whole Southwest Ontario, there's a lot of really good deals, especially right now because there's also a lot of distress. So a lot of people are picking deals up.
Okay.
In the East, I know personally, I really like Belleville. I have a bunch of stuff out there. But no, Hamilton, I think, is a pretty strong market.
So Belleville is a strong market, you're saying?
Belleville could be a strong market. There's less volume of deals.
Okay.
So, I would love to do a lot more in Belleville, but I think, the Southwest Ontario, it's just a lot higher population density
Okay.
than Belleville, for example. So you see you see more competition, but you also see a higher volume of deals.
Okay. And is it easy to get financing in Southwestern Ontario?
Yeah. Yeah.
Okay.
Yeah. I mean, Hamilton's a pretty established market. There's a lot of these, mid 1900s and on sort of purpose-built multifamily buildings. So there's a lot to be done there. I see a lot of clients doing a lot of value-add stuff there. I have a couple of clients who bought in Hamilton within the last 6 months, straight direct to CMHC with 15% down. I just think where we're at as of today in the market is this interesting sweet spot where prices have come down enough that the rents can support the CMHC loan.
Okay. So, let's say if I have 100K, can I do something with multifamily or no?
With 100K, it'll be challenging to get into a 5+ unit in Ontario.
Okay.
I'd say, if you want to get in, you're probably looking at some sort of house hack opportunity, right? So, probably starting with a smaller multifamily, so like a duplex conversion style project.
Okay.
That's how I started in the game.
Okay.
Was doing a house hack where, you can get a purchase plus improvements loan where you only need, minimum 5% of the purchase price plus the renos. Buy something in Brantford, Hamilton, live in the top, finish the basement, rent it out, refinance, or, just keep the equity in there and get heavier cash flow.
So if you need to get into the multifamily 5+ unit space, you cannot start with 100K. You need to start with like at least $500,000.
I would say between 300 to 400K in Ontario.
Yeah.
Between closing costs, land transfer tax, that's probably what you're looking at. I'd say with 100K, if you want to get into 5+ units, you're probably looking at some sort of Alberta deal.
Alberta deal.
Yeah, because you can put the 5% down, or potentially more like Northern Ontario. To be honest, I don't know much about the Northern Ontario markets.
Okay.
I've seen people opt more for, at the end of the day, and again, this is subjective, it's like, do you want to be in Northern Ontario? Or do you want to be in Calgary or Edmonton? And I think most people, if they had to choose, they pick Calgary or Edmonton.
Okay.
Yeah, because
That's a city.
Yeah. They're major cities fueled by oil and gas, no landlord friendly. So yeah.
So, in your opinion, are people underestimating or overestimating the multifamily investing space?
I think the last 3 years have completely knocked the wind out of some people. So I feel like now people are a lot more calibrated on the reality of multifamily.
Okay.
I think 2 years ago, people were a little bit too bullish on what turnovers could look like. They were expecting 100% tenant turnover on value add projects. And I think people have sobered up a bit to the reality of multifamily. I still think in some markets, people are still a little bit going too aggressive on their rent projections.
Okay.
We are in a declining rent environment.
Yeah.
I don't think we have much further to go. But I do see some of that optimism in certain pockets of the market, especially in downtown Toronto.
Okay.
Overall, though, I feel the last 2 to 3 years have really sobered people up.
Okay. That's good to know. Yeah. Okay. So can somebody, in your opinion, go from owning 0 property and to having a portfolio in 2 to 3 years, realistically speaking?
Yeah, big time. I've helped multiple clients do that.
Okay.
I think, though, in order to...
What's the formula? What's the secret?
It's got to be value add.
Okay.
So typically what I've seen clients do is start with, the duplex, triplex, fourplex type thing. Some sort of value add, refinance, continue, or getting into the smaller multis. So for example, like one client bought an absolute piece of crap, 5plex in Brantford, 900 grand. We bought it with a private lender. They put renovation money into it. The guy was a contractor himself. We're refinancing into CMHC. He's pulling quite a bit of money out. He's going to recycle into the next. So I think if you want to scale a portfolio quickly, value add has to be the way to go, because that's the only way to access your equity a lot quicker.
Okay. And what's the biggest lie people have told you about real estate investing in Toronto?
I think the biggest lie in today's world about real estate is that cash flow will make you rich. Um, I think this whole myth of people living and retiring just on cash flow is very tough. With the way prices have gone, especially in Toronto, I mean, $500 a month is not going to make you rich. And as soon as you lose one roof, anything you've made just goes into capital expenditures. I heard on the Bigger Pockets podcast one time, which really stuck with me, that your cash flow is really your right to retain the property. So you want to be cash flow positive to kind of make this a self-sufficient asset for the long term. But, I think a lot of people, especially during the COVID days, low interest rate days, they thought, okay, I have this many rentals, I can just quit my job. I think you need a lot of property to fully replace an active income. And I think it's one portion of an investment portfolio, but not necessarily the whole thing. So I think that's the biggest lie.
Cash flow positivity is very important.
It is, but that's not what's going to make you rich. It's the value add gains, it's the equity gains, it's the long-term holds. That's what's going to build you wealth. Like real estate does not.
So it's just one portion of the strategy.
Correct, yeah.
Okay. And what's one red flag you want to point out, when you see, okay, I don't want to do this deal. I don't want to do this multifamily deal.
Yeah. I think a big part of it is structural issues, building issues.
Okay.
Lenders have looked at deals where cash flow is super strong, price is amazing, location is great, but you do a building condition assessment and you have, $500K in capital expenditures over 5 years. That not only kills the deal for the lender, it really should kill the deal for the client as well.
Okay.
Because even if you get a discount on price, you're in the renovation space.
Yes.
You don't know what you don't know until you open the walls.
Yes.
And a building condition assessment is from the outside.
Yeah.
So I'd say that's the biggest thing, especially as people get into some of these older buildings. It's definitely big to a key consideration to have for sure.
So you really have to do your due diligence.
Yes.
Okay. And so who's your ideal client? And how can people find you?
Yeah, so I think my ideal client is just somebody who's hungry, man. I think, over the long term, I built my own portfolio from house hacking to now, 20 plus unit buildings. It takes time. It takes, just discipline. And I think anybody who's willing to do that and have fun while doing it, I'd love to work with them and help advise on how to scale. Maybe they own a bunch of properties already and they want to build more. I think that's what it is, that ambition and drive. I just love to surround myself with people who have that similar ambition and drive.
And how do people find you? Do you have any Instagram, any website?
Yeah, Instagram, Ribhu Rampersad.
Okay.
So I'm on Instagram. DM me there, shoot me an email. Email is ribhu@ribhurampersad.ca.
Okay.
But yeah, everything's on Instagram. Instagram's pretty easy to get a hold of.
So you're easy to reach out.
I think so.
All right, Mike. Thank you very much for your time.
Yes.
And for the knowledgeable information. It was really helpful, and I hope my viewers and they can really benefit from it. Thank you.
Thank you for having me.